Hey guys, Toby Mathis here, and today we're going to go over the IRS new brackets. Just came out this week that are adjusted for inflation. I always like to point out there's certain things that are adjusted for inflation, and there's certain things that are not in the tax world. For example, child tax credit is not adjusted for inflation; it's at a fixed amount. Capital gain loss limitations at $3,000 per year doesn't get adjusted for inflation. What's another one that might be out there that you guys probably have to deal with? Probably the state and local tax limitation, the SALT deduction. If you're itemizing your deductions, it's at $10,000. It doesn't get adjusted for inflation, but the tax brackets as a whole get adjusted for inflation. And so you can see the difference between our tax brackets in 2024, sitting over here, in 2025. Now this is single filers. I'll just make this easier to read. And then this is married filing jointly. I'm not going into headed household and married filing separately. I'm just going to do the two big ones that we're always dealing with. And you can see that they've been adjusted upward. Now they adjusted upward at about 2.7%. That's the numbers that I'm seeing. So that's supposedly what inflation was at. And obviously that's nuts because inflation's just been absolutely on a tear. And but the government comes up and says, here's the inflation adjustment per year. And what it's meant to do is increase the amount that would be increase the amount of income that is subject to the lower brackets. And let me kind of give you an example. I'm going to use the married filing jointly. I'm going to break this down as to what it would look like if you were doing your taxes. If you've ever done your own taxes, this is how they equate it. It's not that as you make more, your tax rate goes up on the entirety of the dollars. No, we're on a graduated tax bracket system so that each level you pay a certain amount. So for example, if this is for married folks, if your income is not over $23,850, you're going to pay 10% of the taxable income. Now, if you're making $20,000 a year, you're like, oh, shoot, I have to pay 10%. No, you have a standard deduction. And the standard deduction was adjusted to $15,000 for single, $30,000 if you're married filing jointly. So in this case, if they were married filing jointly, they would pay no tax, right? Because the standard deduction is going to wipe it out. But let's just pretend that this person was making $50,000 a year. If they were making these individuals, because they're married filing jointly, let's pretend that they were making $50,000 a year. We would take off the standard deduction of 30, and they have taxable income without getting into IRAs and things like that. Let's just say that they're at 20,000. Then you would just go right here and say, oh, they're under $23,850, so it's 10%. So their taxes would be $2,000. Boom. Really easy. Federal taxes. They still get their state, but you get the idea. Not too bad. That's why everybody's, they say, oh, half the people don't pay taxes. Well, this is just income taxes. If you made wages, you paid old age, disability, and survivors on your employee half. Your employer paid half, which is 12.4% total. And you had Medicare, so 2.9. So there was somewhere in the neighborhood of 15.3% that was paid. Now let's say that you are making $80,000. So let's just say you're making 80 grand after. So I'll use it like this. Let's say you're making 110,000 during the year. You made a standard deduction of 30, which equals $80,000. Okay. You take it over here and you say my $80,000 falls over here. So I'm at 80 grand. I'm in clearly here. So you're going to pay $2,385 plus 12% of the amount over $23,850. So we would take 80,000 minus that 23,850. And let me just get my handy dandy calculator here. Minus 23,850, which is going to give us 150 times, there's your 12%. So you're going to have 6,738 plus that 2385, because that's the 10% of the first 23,850. So total tax that you would be paying, federal taxes, would be $9,123. See if I can write that down. That's how these tax brackets work. So I just want to make sure that we are clear. Now, this is if you're making wages. Now, what if a portion of that was a bunch of capital gains? What if you were half and half? Well, then it actually gets more interesting, right? Because our brackets on the wages of our taxable income, well, we're not going to pay nearly as much, because if you have long-term capital gains, then they are taxed at a lower level. And right now, it's at 0% for married filing jointly right here. And this is for 2025. This is what they just went up to. If you make less than $96,700, your tax bracket on those capital gains is 0%. If you are between $96,700 and $600,000, just over $600,050, then you're at 15%. And if you're over $600,000 and $50, then you are at 20%. So that gives you what it is. Any amount over that, I guess we just leave it at that. You can figure it out that we have an amount between those two that's 15%, and then anything above 600,000 ish, right, is 20,000. If you're married, if you're single, that's where these guys are going to go, is all other individuals. First 48,000, or if your income is below 48,350, and it includes the capital gains, guys. So don't think, oh, if I make $10,000 a year, I can make $1 million of long-term capital gains and be at zero. No, $1 million would move you up the brackets, and you'd have some of it at 0, some of it at 15%, some of it at 20. So here I am looking at my single, and then the top level, so 15% is in between these. Here's your 0, and then anything above that is at 20%. It's $533,000. It's actually not too bad. I'm looking at that going, shoot, the single's not so bad as far as the capital gains are concerned. But it's also telling you, by the way, hint, 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 long-term capital gains are tax advantage. So dividends from qualified companies like U.S. big companies that are paying out dividends, if this is you and you're in that 0%, those dividends are 0%. If you're getting long-term capital gains, you're selling securities or you're selling real estate, and you have some capital gains, you might be looking at 0 or 15%. It's a tax advantage. So anyway, I just wanted to hit that, get that out to you guys, that the brackets have changed. I'm going to go back to the very first slide. You can always take a screenshot of it or whatnot, but I'm sure I'll be using this throughout the years and using these numbers. But this is what they published. When I say they, the IRS did a revenue procedure with their inflation adjustments. So it's literally published out there for everybody to take and use. And you can start to see, yes, they ticked it up slightly. Figure, give or take right around 3%, because that's the supposed inflation rate. So your taxes may have gone down slightly in 2025. Of course, with inflation, your wages should be increasing. So it's all going to net out. But that gives you an idea of what those changes are. Hey, if you know anybody that could benefit from this information, share it with them. And if you could, like and subscribe. Thanks, guys.